When it comes to investing, everyone says you need to be investing into the S&P 500. But what exactly is the S&P 500? What exactly do you need to know? And how do you go about starting to invest into it? In this video, I'm going to top line touch on all three of those questions so that by the end of it, you're going to understand exactly what it is and exactly how you go about starting to take control of your financial future. S&P, in the first instance, stands for Standard & Poor's. It is a company that is a creator of market indices. It's widely used in all sorts of different aspects of the financial markets in terms of benchmarking, in terms of issuing credit ratings, in terms of data sources, but it is most commonly known as a creator of the indice, the S&P 500. So the S&P is Standard & Poor's, a financial company. The 500 represents the 500 biggest companies in America. So instead of investing into Apple or Microsoft or Nvidia or Tesla or whoever it is you want to invest in, if you invest into the S&P 500, you get exposure of all of these companies, of all 500 of the biggest companies in the US. Now, historically, it has been very difficult to beat the S&P 500. What I mean by that is you put £100 into the S&P 500, and typically, on average, over the last 100 years or so, you're going to get 9 or 10 or as much as 11% on average returns. It is very difficult then for an individual investor or professional investor to go out there and try and pick companies that is going to beat that average return in the long term. Now, a lot of people have been successful in doing it in the short term. Very few people have been successful in doing it in the long term, but they become multi-billionaires, millionaires. You've probably even heard of them, the likes of Warren Buffett. In reality, an individual investor and most professional investors are not going to be. So by investing into the S&P 500, you get exposure of all of these companies. Some of them will be doing well one year, others will be doing well another year, but you have got what is called diversification across all of the companies. Now, whilst it's called the S&P 500, there's actually more than 500 companies in it. Typically, there is around 503, 505 companies, and that's because, well, some companies have got different types of shares. They might have Google A, Google B, Google C, just for whatever tax reason or investing reason. So it's actually 500 companies, but there'll be 505, 503 actual stocks within the 500 list, just to make it more complicated for you. But don't worry about it. In fact, Standard & Poor's don't actually print for free the full list of the 500 companies, and it is changing quite regularly. Some are getting kicked out, some are getting added in, but they won't regularly update a list that you can freely and easily find on the internet. You can find the top 25, the top 10. We'll go through that in a minute. Now, this list, the S&P 500, was actually originally created in 1957, so it's been running for well over half a century now. And in order to get listed on the S&P 500, you need to meet a list of certain criteria. First of all, you need to have a total market cap of at least $14.5 billion. Market cap means the value of the company. So you need to be worth at least $14.5 billion as a company. You must be a US company. A float adjusted liquidity rating of equal to or greater than 0.75. Again, don't worry about that. That just means you need to be a liquid company, have access to cash. You need to have a positive sum of earnings over the last 4 quarters. Stands to reason. You need to be a good, strong, stable company, high market cap, be making money. You also have to have positive earnings in the most recent quarter, of course. And again, you must meet certain liquidity requirements. So basically, you need to be big enough, you need to be regulated, you need to be making profit, and you need to be liquid. Simple as that. And actually, if you deviate away from any of these criteria, you can be removed from the list completely. Now, the S&P 500 is something called get this right, free float market capitalization weighted index. And that basically means that all 500 companies are not broken down equally. So the higher the market cap or the value of the company, the greater the proportion of the index you will take up. For example, the number one business in the S&P 500 at the moment is Apple, and that takes up 7.05% of the index, so much greater than a proportion of 500 divided by 100, if you like. So if there was 500 companies and it was an equal split, 100% of the value of the fund, you would have 0.2 of every company, because 0.2 times 500 is 100. But it's market weighted, so the bigger the business, the more allocation you have. So Apple, for example, has 7.05% because it is worth a lot more than any of the other businesses. This then means that the bigger a business is, the more weighting it has within the fund, if that makes sense. It is also weighted by sector. So for example, number one is information technology at 28.2%, healthcare at 13.2%, and then it goes down financials, consumer discretionary, communication services, industrials, all the different industries as a weighting of the value of their businesses as a proportion of the fund. So the S&P 500 is about thereabouts 500 of the biggest companies in the US. It is a collection, a basket of those companies weighted towards the most valuable. And so investing into an index that tracks the S&P 500 will give you exposure to all of those companies. If you put £100 in, you are going to be investing in all 500 businesses. It gives you the diversification, therefore it has seen stable growth. Sometimes there's up years, sometimes there's down years, but on average, it has delivered around 9-10% over the course of the last 100 years, which in reality has far exceeded the capability of any individual investors on average. So it is often seen as one of the best ways to start investing. Now, one of the things to bear in mind is it is US only. So who knows what the future is going to bring? Will the US be the biggest market in the world in 10, 20, 30 years? Who knows? But what you are doing when you invest into the S&P 500 is just getting that American exposure. Now, a lot of the companies are represented throughout the world, so you do get a certain amount of geographical diversification, but it's worth bearing in mind that you are specifically investing into the US. Now, in order to invest into the S&P 500, you need a brokerage or an investing platform or whatever they're called these days. Best way to do that, in my view, at the moment is through Trading 212. If you open a Trading 212 account, there's a link below. You can search through all of the funds that are available. You can look for S&P 500 specific funds and you can buy one of those. It's as simple as that. With Trading 212, you can buy fractional shares. That basically means you can buy a percentage of the index. So you can start with as little as £1 and invest into all 500 companies in the US. So I wanted this to be really top line. I wanted you to have a better understanding of what the S&P 500 is. I'm not going to go through specific charts and performances and stuff like that. At this point, it's an introduction to the S&P 500. So hopefully that gives you an understanding of what it's all about.
The S&P 500 index is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of, of everything you can buy in this country. And it's over, I think it's over 20 trillion. And you're buying America. And let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942. Shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man!
Well, it's
okay.
But I just want your audience to think for a second.
Okay.
The answer is about $400,000.